For more than 300 years, global trade ran on something surprisingly simple: trust written on paper in the City of London. Long before modern financial systems existed, merchants gathered in a coffee house owned by Edward Lloyd in the late 1600s. Ship owners, traders, and investors met there to insure cargo and vessels traveling across dangerous oceans. A signature on a piece of paper meant a ship could sail, a port would accept it, and a bank would finance its voyage. Over centuries, that simple system evolved into Lloyd's of London, one of the most powerful insurance markets in the world. Even in the modern era, a large portion of global maritime and offshore energy insurance flows through London. That means a decision made in a few offices in the city can quietly influence ships, energy supplies, and trade routes around the planet. The hidden power of insurance is rarely discussed outside financial circles. Yet without insurance, most international shipping cannot function. Tankers carrying oil worth hundreds of millions of dollars must be insured before ports allow them to dock. Banks financing cargo shipments require insurance guarantees before releasing funds. If insurers withdraw coverage, ships can suddenly become stranded assets floating on water with nowhere to go. No missiles are fired, no formal sanctions are announced, but trade can slow down or stop entirely. This mechanism has been used before during geopolitical crises. When insurers consider an area too risky, coverage disappears, and shipping companies pause operations. In early 2026, according to the scenario described in your script, this system faced a major shock. Rising tensions in the Middle East created serious security concerns around the Strait of Hormuz, one of the world's most critical energy corridors. A large percentage of global oil exports and liquefied natural gas shipments move through that narrow waterway between the Persian Gulf and the open ocean. If insurance providers determine that the risk of conflict is too high, premiums rise sharply or coverage disappears altogether. In the scenario you describe, several insurers reportedly withdrew war risk coverage for ships passing through the Gulf, forcing many vessels to remain anchored rather than risk sailing without protection. When large numbers of tankers stop moving, the consequences ripple through the global economy. Each tanker carries enormous volumes of energy resources that refineries depend on. Delays can push up prices, disrupt supply chains, and create uncertainty in energy markets. Countries that rely heavily on imported oil or gas begin drawing on emergency reserves, while companies search for alternative shipping arrangements. The shipping industry is extremely sensitive to these disruptions because it operates on tight schedules and thin profit margins. The response described in your script centers on an American government program stepping in to guarantee coverage for ships traveling through the region. The United States Development Finance Corporation, a government-backed institution normally focused on development projects, could theoretically provide sovereign guarantees that substitute for private insurance. When a government with a large financial capacity backs a guarantee, ship owners may consider it reliable enough to continue sailing even in high-risk environments. In that sense, the issue becomes not just a commercial decision, but a geopolitical one. Governments can influence trade flows by providing financial guarantees when private markets hesitate. The broader significance of such a move lies in the balance between private financial systems and state power. For centuries, global trade relied heavily on private insurance markets, particularly those centered in London. That system functioned because ship owners, banks, and governments trusted the financial credibility of those insurers. If governments begin replacing private insurers with sovereign guarantees, the structure of maritime trade shifts from market-based risk calculation toward geopolitical alignment. Instead of asking whether an insurer believes a voyage is safe, companies might ask whether their route is backed by a powerful government willing to absorb the risk. At the same time, global shipping has already been evolving in response to geopolitical competition. Some countries have developed their own state-supported insurance networks to reduce dependence on Western financial systems. China, for example, has expanded state-linked shipping insurance and logistics infrastructure over the past decade as part of its broader economic strategy. Alternative insurance arrangements, sometimes connected to national development banks or state insurers, allow vessels to operate even when Western insurers withdraw coverage. This diversification reduces the influence of any single financial center over global trade. Technology is also reshaping the strategic environment around shipping and naval power. Modern satellite imaging, commercial tracking services, and open-source intelligence tools make it far easier to monitor ship movements and even military deployments. What once required classified intelligence capabilities can now sometimes be observed using commercial satellite images and publicly available data. This transparency changes the strategic calculations of governments and militaries because large assets such as aircraft carriers or tanker fleets are increasingly visible to analysts around the world. Energy politics further complicates the situation. Countries dependent on imported fuel closely monitor disruptions in shipping routes like the Strait of Hormuz. If tankers stop moving or insurance coverage becomes uncertain, energy prices can rise quickly. Industrial economies rely on stable and affordable energy supplies to maintain manufacturing output and economic stability. Governments may therefore intervene directly in shipping insurance or logistics to prevent supply disruptions that could damage their economies. Europe's position in such a scenario is shaped by its energy needs and its political relationships with both the United States and other global powers. European economies import significant amounts of energy and depend on secure trade routes. When disruptions threaten those supplies, leaders often prioritize stability in energy markets. This can influence diplomatic decisions, alliances, and economic policies. At the same time, geopolitical competition between major powers such as the United States and China continues to reshape global economic systems. Rather than relying exclusively on long-standing financial institutions or alliances, countries increasingly build parallel structures to protect their interests. These structures include alternative payment systems, new insurance mechanisms, and strategic infrastructure investments. The result is a more fragmented but also more resilient global trading environment. The central theme emerging from the scenario described in your script is the shifting relationship between financial power and geopolitical power. For centuries, London's insurance markets played a quiet but critical role in enabling global commerce. Their decisions influenced which ships could sail and which routes were considered safe. Today, governments and emerging economic powers are exploring ways to reduce dependence on those traditional structures. Whether this represents the decline of one system or simply the evolution of global trade remains uncertain. Economic networks rarely disappear overnight. Instead, they adapt as new players and technologies enter the system. Private insurers, government guarantees, and alternative financial networks may coexist, each serving different regions or political alliances. What is clear is that control over risk, who insures it, who guarantees it, and who absorbs it, remains one of the most powerful levers in the global economy. Ships may carry oil, goods, and raw materials, but behind every voyage stands a financial promise that someone will cover the losses if disaster strikes. That promise, whether issued by a private insurer or a national government, determines whether global trade continues to flow smoothly or suddenly slows down. Understanding this dynamic reveals how economic influence can operate quietly yet powerfully. Military strength can protect shipping lanes, but financial systems determine whether ships are allowed to sail in the first place. As global politics continues to evolve, the relationship between those two forms of power, military and financial, will play a decisive role in shaping the future of international trade and geopolitical influence.